In this video, traders, we'll look at trading and interpreting indicators differently. Hey traders, a very warm welcome to you. So indicators, we have got thousands of them out there. You know the score, you've got oscillators, you've got kind of trending indicators. You've got a sea of different styles, and most people will trade them in the way that they've been designed, i.e. moving average. Hey, price is above my moving average, I want to stay long. Price is below it, I want to stay short. Fast crosses the slow, long signal. Fast goes under the slow, short signal. Fine, makes sense, all well and good. Well, I think there is a few extra hidden gems that we're not looking at when it comes to indicators. And if you know me and if you've been subscriber to the channel, you're going to know that I often talk about the usefulness of indicators and how you got to be careful that you don't overuse them, and also how you can interpret them differently, which is what this video is all about. And I'm going to use the Bollinger Bands as a great example. I'm going to touch on RSI as well if we get time towards the end of the video. But look, when you're trading something, you want to use the indicator as a filter, as a tool, as a trigger. Whatever it is, there is a purpose to using. You're trying to get it to tell you something about the market. Is it strong? Is it weak? Is it perhaps stretched? Is it perhaps kind of quiet? Something that helps you make a trading decision. So if we look at Bollinger Bands being standard deviation bands around a moving average, normally a 20-period moving average, normally 2 standard deviations above, 2 standard deviations below, giving us a kind of band that expands and contracts. There are multiple ways of looking at Bollinger Bands, just as there are any other indicator. And I've just put some of them up here. And these are ways that we can kind of use as a filter or as a trigger. So just from one indicator alone, we have a multiple different ways of doing it, which is why the key is to look first at what we're trying to achieve and then find an indicator and a signal that's going to solve that solution, as opposed to looking at all of these and utilizing what they could tell you. So in other words, hey, I want to not chase the market. Let me find a tool, an indicator, a trigger on that indicator that's going to help me not chase the market. Don't buy an oversold, don't buy an overbought conditions, don't buy above an upper volley. But anyway, let's look at a Bollinger Band example, then we'll go back to that point. So Bollinger Band cruising along, we can have at least 7. Price crosses above the upper Bollinger Band, price crosses under or below the upper Bollinger Band. 2 distinct different things, right? 2 distinct different triggers. If we're trading short, maybe we don't want to trade it as it crosses above it, because that thing could run and rip. Maybe we want to wait and see if it starts to tail off and see a bit of selling, and we want to sell it, I want to short it as it comes back into the upper Bollinger Band. Distinct differences, very different signals, guys, very different signals. And there's a time and a place for both of those. Even though it's an upper volley and it's price, and people generalize and say price hits the upper volley. No, there's 2 different ways of looking at it. Same when we're looking at the midpoint, which would be a moving average. It crosses under it, it crosses over it, depending on how we're doing. Do we want to go long as it's crossing under it, or do we want to wait until it's come back up under it? Again, different solutions. And then just mirroring that with the lower Bollinger. So under the lower and over the lower. Exactly the same thing. Would we want to go long as it's hammering through the low end Bollinger? Maybe we wouldn't. Maybe we would want to add to the position then as it comes back up under. These are kind of different things that add a different flavor to the trading. And then the final one, of course, price staying within the band. And that could be within the upper band, and then the mean in the upper band. The lower band is in the moving average and the lower band. All kind of stuff. And then you can go even further in that and say 3 days above the upper volley, 3 days below the lower volley, touched the lower Bollinger twice, multiple things. But the point is, guys, is that we're not just talking about this from a kind of operational perspective. We're looking at it from, hey, we can utilize indicators in a different way to give us a filter or a trigger to help us make better trades. That's the key. That's what they should be used for. They should be used for that, rather than saying, oh, I'm going to try and get a signal from this and then taking it. It should be, hey, let me help solve a problem. Look at RSI. Overbought, oversold. Would we want to go short in an overbought condition? Maybe we would, but maybe one step better is to say that's my filter, and now I'm going to look for a price action short, or I'm going to go for a short as we cross from overbought into oversold, or I'm not going to go long while we're in overbought condition. I'm only going to go long when we come back into neutral territory, or whatever it may be. It's just looking at indicators in a different way, interpreting them differently, and just thinking an extra layer, just to give you that little bit extra edge over everyone who's using it in the kind of same boring way, and just saying, okay, well, I'm going to go short if it's overbought, I'm going to go long if it's oversold. No, well, actually, maybe I'm going to wait until I see my first overbought condition, then I see a second overbought condition that's not as high, so maybe I see some bearish divergence as we kind of come up to the highs, then I'm going to take it. It's just taking that extra layer, isn't it? Just thinking one extra step ahead. All right, guys, that's interpreting indicators differently. See you next one. Take care. Bye-bye.